You started in 2019 and we are now in 2023, and we have seen hBits seen a quite good substantial growth. So what would you see are the key factors or the key points which helped you or your company to grow in such a short period?
I think main is just having this philosophy of building trust and transparency within investors. So building that trust, building that investor base in a slow, steady way. And then from a team perspective, I think I have to also give props to the team. They've worked very hard. And one of our mantras or strategy within the team is it's how in real estate you say location, location, location.
Yeah.
For our team, it's all execution, execution, execution. You can strategize as much, but it's about getting the basics right. That's all it is. You get the basics right. You don't overthink that plan this. You get the basics right. You just think about the next day and do the thing that needs to be done. We already know what needs to be done. It's just about doing it. So that's our mantra within our team right now. So that's how we've got into it. Yeah.
So tell me, when it comes to goals, right? I'm sure the time you started hBits, you must have certain milestones to achieve.
Yes.
And now in 2023, I'm sure the goals must have changed.
Yes.
What are your current goals or milestones you want to achieve?
So we definitely have targets, right? So far we have 250 crore under management. We want to take that number to 1,000 crore in about the next 9 odd months. We would like to have properties across the top 6 cities, and that's very possible. We have a very strong team in place, and we want to have in our long-term goal, is to have 10,000 crore in the next 4 years. And I think that's very achievable, because I was just, I was in fact discussing yesterday at a conference only that the overall mutual fund industry is 46 lakh crore. The amount of individual wealth of just individuals combined in the country is approximately 450 lakh crore. Out of that, 80 lakh crore is in residences, in real estate. That's not your primary residence, so as an investment.
Yeah.
And that's in basically, so far that's only been in residential real estate.
True.
So moving that 80 lakh crore to this is the long-term goal, right? And real estate as an asset class. What does an investor look for, right? An investor looks for 5 things in any product, whether it's an FD, equity, real estate, gold. There are 5 things: safety and capital preservation. They don't want to lose their capital. That's number 1.
True.
Money safe. Yeah. Number 2 is return maximization.
Yeah.
Make as much returns as possible. Number 3 is transparency and good governance. Just being completely transparent, and that gives also a lot of psychological comfort to the investor. Number 4 is hassle-free ownership. That once I put my money in, I've done my due diligence, then I don't want to think. Then I know I've done my research. I can't keep tracking it. I have my job. I made an investment. And number 5 is liquidity.
Yeah.
That when I want to exit, I can exit. If not the same day, I know that okay, in 1 month or in 45 days, I'll be able to exit. That comfort and that when I need it, I'll be able to get it. Those are the 5 things in any investment. Real estate traditionally has offered number 1 and 2. Right? It's offered good return. It's offered stability because it's a hard asset.
Yeah.
And land is kind of limited in cities.
Yeah.
3, 4, 5 is where real estate has traditionally been lacking. It's been an opaque industry, no transparency. You don't know even when you're buying an apartment, you have to really figure out that in the neighboring building, what is the price, what is the rental. It's very opaque. Hassle-free ownership, you're owning it on your own. It's not easy. Anyone who has a second apartment, managing that, is not easy. And real estate traditionally has not had great liquidity. You have to wait several 6, 8 months to exit. So through this platform, we're aiming to give number 3, 4, and 5: transparency, hassle-free ownership, and liquidity. 1 and 2 are already there to the investors. That's kind of the vision. And market is large, right? Like I said, on the investor side, India has 460 lakh crore of individual wealth. 80 lakh crore already in real estate, 46 lakh crore in mutual funds. On the real estate side, just offices, and we look at everything. We look at warehouses, data centers, schools, but just offices, grade A offices, is basically $100 million. So to reach 10,000 crore, which is about $1.5 billion, 2 years, 4 years, is what our plan is. And so we are taking a small, out of that we want to take the best properties, that's
so tell me, what kind of regulation goes for the fractional ownership, because there are so many now players getting into this, right?
Mhm.
And as an investor, and personally, I would also fear that if someone is managing, and it happens with everyone, whoever even doing mutual, funds, that you are having the right fund manager, a known brand
Absolutely.
player in that market,
Absolutely, yeah.
because anyone can shut down in the middle of the night and can go
Correct.
with your money, right?
Correct.
So as an investor, I want to understand what kind of regulation goes for fractional ownership.
Yeah, so I think that's where we are very happy that, and in fact, we've been part of the consultative process with SEBI. So SEBI came out with a consultation paper in the middle of May, and they call it MSM REITs, medium, small, and micro REITs. So they are bringing this fractional ownership industry, which has grown over the last 4 or 5 years, under the ambit of SEBI. I think that's a great thing that's happening. And we've been part of that process, giving our thoughts to SEBI. I think that's great for the industry, great for the investors.
Yeah.
There's certain things that SEBI have put in this consultation paper, which will give comfort to that investor, right? They've given disclosure requirements. What all needs to be disclosed to investors. That helps on the transparency front that I was talking about.
Yeah.
Right. They've given net worth requirement. They've given background of they've called it investment manager, so background of the investment manager in terms of experience, etc. So that takes care of the hassle-free ownership.
Yeah.
And then they're talking about listing it on the exchange. So that takes care of the liquidity part. There are obviously other parts, but overall it's very positive for the industry.
So there have been quite discussion. Good, you brought the REIT up, because we also have seen in past, wherever we have interviewed people or even written editorial content, a lot of people have commented, and I've put that together, and I want to ask you. People have commented asking how different it is from REIT, and why should I invest in fractional rather than why not invest in REIT, where my returns are much quick and I can get bigger. So how do you answer that?
See, that's a great question. REIT and fractional ownership are siblings in a way, right? Underlying asset is the same. Commercial real estate, great tenants, long-term leases, 8 to 9%. So that way, yes, underlying asset is the same. It's the structure that's different. And the way to easily explain it is the way mutual fund is to stocks. REITs is to fractional ownership. Right? Mutual fund, you're giving your money to a mutual fund manager who's allocating it across multiple stocks. In the same way, in a REIT, you're giving it to the REIT manager who's allocating it across multiple properties. Obviously, in India, the 3 or 4 REITs that exist today, the manager itself, it's their own properties are listed. So that is one thing that's slightly different. We are completely impartial in terms of the property. We don't know, it's not our properties that we're bringing onto the platform. While all the 4 REITs, it's the same developer who's become the manager. Other is, if you look at historically, REIT has been, because it's listed on the public stock exchange, it's very correlated with the stock market. Fractional ownership, because you're owning one asset, that asset value doesn't fluctuate. That depends on the actual asset value. So these are a few theoretical reasons. Practically, what it is there different investor segments for both. Our investor segment, likes to look at the leave and license agreements, like to look at the title report. They like that level of analysis. They like the psychological comfort of saying, okay, in this property, I'm a 1% owner or 2% owner. In REITs, in each REIT, there are 200 odd tenants. No one has the time to study 200 different. So if someone wants to do their own investment, their own research, then they'll go for us. If someone wants just to not think and much too much, then they'll go for REIT.
So would you say someone who is looking for long-term returns should invest in fractional, and someone who is looking for good or quick returns should look into REITs?
I would not say that. I would say they're both great asset classes, and I think long-term returns. I think both. Some of the short-term return mindset, I don't think REIT or fractional ownership is for them. I think both will be long-term returns. I think it's more on just the how close that investor wants to be to that asset, right? And I think a lot of investors want to have that comfort that they've looked at the leave and license agreement. They can see the building, say in this building I'm a 1% owner. So it's very different in that sense.
So currently, what is hBits team size and where all you guys are present? Also, what are the ongoing projects going on?
Yeah, so in terms of team, we have and that's where we pride ourselves on. We have a very, very solid and strong team. We're about 50 people across Mumbai, Bangalore, and Gurgaon. And to talk about some of the senior leaders in our team, our CFO and co-founder, Sameer, was heading global sales for Nomura. 30 plus years experience, chartered accountant, IIM Ahmedabad grad. So comes with a wealth of experience. Mayank is our CIO, 20 plus years of experience in investing. Worked at your best private equity companies like Logos and Indospace, Everstone. He was there for 10 years. You have Mihir, who's our head of investments and partnerships. He has a blended experience in real estate as well as in finance. Worked at companies like Savills, and then worked at companies like HSBC and Citi. We have a director of technology. We have a digital marketing team in house. So very, very strong and solid team. In terms of projects, right now we have one that's going on in Powai. It's Boomerang. That's the project that's ongoing right now. And we should be launching a few more very shortly in the next month or so.
So recently, SEBI approval for hBits to raise funds through Category 2 AIF is quite significant. So how do you envision this, utilizing this regulatory backup to enhance your platform offerings and impact?
Yeah, so we recently got approval for our AIF. AIF is an alternative investment fund. So that structure is a little bit different to the traditional fractional structure that we have. And I'll just explain the difference before talking about what we're going to do with the AIF. So fractional, what happens is we list the property and then investors can see all the details of the property and then decide whether to invest or not. And they become part owners in that one property. So they'll see that this property is located in Andheri, this is the building, this is the photos, this is the tenant, this is the return. They'll see all that and then they decide whether to invest or not. So that's fractional ownership, property by property. AIF is more like a fund. So what that happens is that we tell investors that this is the kind of investments we're going to make. Minimum, you have to make 4 investments in an AIF. That's by regulation. So an investor gives us the money first, and then we invest in property. So that's the structural difference between the two. In our specific AIF, it's a 500 crore AIF. And we are going to invest for us, fractional is already constructed properties, already rented out properties. For the AIF, we are going to invest in a combination of under construction properties as well as pre-lease properties. So that's another difference between the fractional and the AIF. And as per regulation, our minimum ticket size in the AIF is 1 crore.
1 crore.
So given that it's under construction, your return profile is obviously higher. So we're targeting about a 20 odd percent return for the AIF. So at a high level, that's the difference, and that's what AIF gives us. Reason we're doing it is there are obviously good pre-leased opportunities, but there are a lot of investors who come to us and say that we want to invest in under construction as well. We want to get in at an early stage. They're seeing the growth in the industry, and we're investing in a combination of offices and warehouses in the AIF. So that's where we decided that we'll come up with this AIF to give an avenue for those investors to invest in under construction properties as well.
So when it comes to under construction properties, be offices and warehouses under this AIF, what I'm sure the checklist would be different when it comes to this particular assets. So how do you guys go about it when you're selecting such kind of projects or the properties?
Right. So in fractional, right, the checklist, like I already mentioned what it is. So in AIF, we have to look at those things as well, but we'll look at a few other things also over and above that, right? So in AIF, in under construction, the tenant probably won't be in place already. So we'll have to look at what is the likelihood of getting a tenant in that location and how quickly. So we will look at, again, what is the vacancy in that micro market? What are the average prices? So then what price will we be able to rent out our property at? what is the square footage of that floor plate? Because it's not just the average price. The 5,000 square feet market is different to the 10,000 square feet market. Is different to the 50,000 square feet market.
True.
So we go into that analysis and see for that property that we're looking at, what kind of building can come up and what is the square footage and floor plate. So that kind of analysis we do. There we're also going to be working with probably a developer.
Yeah.
So then we do due diligence on the developer. So our focus is only on tier 1 developers, right? Probably your top 20 in the country. But we'll still, just the brand name is not good enough. We'll have to look at in detail. What is the current financial status of the developer? We'll also have to, there's a legal component that comes in as well.
Yeah.
So we have to have very strong mechanisms in place where if the developer is, behind on development, focus is not there, has some issues, then we can step in and take over the project. So those controls, etc., from a contractual perspective are very important. And which is why we work with some of the best law firms in the country. For the structure, like I mentioned, we work with Vadya Gandhi. On the real estate side, we work with Shardul Amarchand Mangaldas.
So in terms of AIF for commercial, because I had in past interviewed few AIF companies who are looking to the residential projects, and they are also having certain checklists when it comes to developers doing the thorough research in terms of even why a stalled project is a stalled project or a stressed project is stressed, and they step into micromanaging everything in terms from the contractor or changing the team or
controls on escrow. So
control on the escrow, also changing the kind of materials that are coming in. They might bring a cheaper material but good quality. All of that is considered when they get into the residential front. I want to understand when it comes to commercial, how you said that you do the thorough research. Of course, a branded developers gives that kind of assurance that yes, the project will be completed on certain time. But apart from that, if there's an issue when it comes to it's under construction project, right?
Yes.
There can be issue in terms of the developer not able to achieve certain milestones.
Correct. Yes.
How do you step into that particular stage, and how you make sure your stakeholders' investments are intact and protected when you're facing certain challenges? Because I'm sure the challenges in under construction projects would be far different from already existing projects, right?
Far different and far more.
Yeah.
Right. That's just the nature of, which is why they're getting higher returns.
Yeah.
So I think the important part to add is, like I mentioned, we have that real estate development expertise. So we know where things can go wrong. So we know contractually what to put in, where things can go wrong and where things you can, that, okay, in contract you don't need to be that strong. Because ultimately it's you're also having a partner as a developer.
Yeah.
And then we'll have, like I said, that the funds. A lot of times developers face issues because of financial closure, because they don't have enough funding.
Yeah.
That in our case is not going to be an issue because we are the ones bringing in the funding.
True.
So we are a platform that's not only bringing in the funding, but also has that development expertise. Most people don't have both those skill sets, right? A developer generally has development expertise, and then he or she raises funding from a bank or from a private equity fund.
Yeah.
Or you have funds, and a lot of these have been global funds so far, or a few now Indian funds, that are people who know how to raise money, they know how to deploy money, they know how to analyze things, but they don't know how to step in and do things themselves. We have that unique advantage because of the background of having both expertise and skill sets.
So how do you make sure the funds, that working capital that you're bringing in that project, how you make sure it's being utilized in the right manner by the developer?
So escrow is very important.
Yeah.
We can have mechanisms where we also sign off on every every check above a certain level, because you're talking about siphoning off of funds, those kind of issues.
Yeah.
Although I think, and you're coming because you've also spoken to a lot of people in the resi sector. In the commercial, even the profile of developers that we will be dealing with by just the nature of the business will just be the top 20 developers. So even though we will have our checks and balances, the reputation of these developers are such as they don't have time to, for them, their brand is so much more important than taking money out of the project in unethical ways. But at the same time, we'll obviously still have the checks in place anyways, and they'll be more than happy to put that in place because they have nothing to hide.
So hBits' role in terms of providing working capital is there, But do you guys also, like how you mentioned, Resi does get involved in the micromanagement?
Yeah.
In every stage of the construction. Does hBits will also get involved when it comes to commercial assets?
To a certain level, yes.
So when you say certain level, in what all stages you guys would be present?
No, so across the board, we'll have, MISs. So we'll enter post-approval stage. We don't enter pre-approval.
Okay.
So in terms of construction, there'll be milestones that we'll be tracking. That the milestones are met as per the timeline, as we have penalty clauses. So those kind of things will be in place when we do under construction projects.
So I'm sure Resi does face this a lot, but when it comes to commercial, what are the exit formalities? Because in AIF, the risk is there, right?
Yes, yeah.
There can be any problem in the developer front or can be a problem in anything. What exit formalities will you guys have in place?
No, so I will say something that's different from Resi and commercial. In Resi, and a lot of these AIFs are doing Resi debt.
Yeah.
We are doing commercial, but we're also doing equity. So that's a slight nuance. In Resi, there's the sales velocity while the asset is under construction.
Yeah.
That the Resi, whichever the AIF is investing, needs to look after and needs to make sure that those are met as well. In commercial, it's very different. Right? In commercial, either you'll have a tenant in place already, then it's already in place, so you're building built to suit, or you're getting a tenant after the construction is done. While for Resi, if you don't meet that sales velocity, then your finances go a little bit haywire. And commercial, you have to underwrite that, if you're doing a speculative project, which is basically a project which is saying that, okay, the tenant will anyways come after construction.
Yeah.
So then you have to just focus on one thing at a time. First, you focus on construction. You don't care about it doesn't affect your sales velocity because funds are provided by us compared to Resi.
True.
And which is why I think the important part was what I'd said at the start of your question, which is where the micro market analysis that once the building is built, how quickly will a tenant be able to come and at what price? I think that is a much more important question to be asked and question to be answered by us as the investor. And that's where that experience and expertise and knowledge comes in, and the analysis comes in that, okay, we have that confidence that when the building is built, we will get a tenant.
So that confidence is based on the data analytics or
analytics, number one. And accordingly, we'll make sure that depending on how much you're investing in the project, what the price per square foot is, you'll have a minimum. We'll have to say that the project will have to be rented. If it rents below 100 rupees per square foot, we won't make money. If we rent above, we'll start making money.
True.
So we have to have that confidence that once the project is built, we'll be able to rent it above that rental. So one is through the data analytics.
Yeah.
Number two is that our plan is when we're close to closure of a project, we have relationships with all these potential tenants. So we start having conversations with them. We have a lot of relations with your JLLs, Cushmans of the world. So we start speaking to them. Okay. So both those factors will play into making sure we get a tenant in time.
So give us one example which is currently under AIF where you have taken upon any project, be commercial or the warehouse.
So AIF, I'll give one example, and the deal is not closed yet. It's under discussion.
Okay.
But it's a asset in Bangalore, and we're negotiating. It's a standalone building. It's a top developer, it's what we noticed that the location is amazing.
Okay.
So, and we look at the rental values of that micro market, and we're confident that I don't want to say too much because I'm negotiating with on the pricing with the developer, but ultimately it's a partnership with the developer, so he also has to ensure that we make money. We have to ensure that he makes money.
Of course.
Then only we have a deal. So that's one example. Where the developer is saying even until the tenant is there, they'll keep paying us rentals because they are that confident in that project.
So just for my understanding, if this particular project was quite lucrative because of the location, right? You're able to see the 5 years or 3 years down the line what would be the rental yields, right?
Yes.
So this kind of deep analysis you guys get into.
Correct. And then you can see based on the rental yield, then you rent it out, you earn rent for a little period, and then you sell the asset to a fund that will buy a rented out asset.
Yeah. Accordingly,
you can model out an IRR. That's why I'm saying this 20% IRR. Under construction will be higher, 25%. And we're doing pre-leased as well. So blended, it'll be 20% IRR.
So coming to your IRR, you have projected, as you said, 18 to 20% for investors is
in the air.
quite impressive, and it's quite interesting also, because that's the claim comes from the hBits, right? So I want to know, can you shed us light on the strategies and factors that contribute to such, strong risk adjusted returns, and how you make sure, or when you're claiming such,
I'll give you some good examples.
Yeah, so when you're claiming such, of course, high IRR, which is quite interesting, and it creates that kind of eyeballs, what are the strategies, and how do you claim this?
So I just want to clarify. 18 to 20% is for our AIF. For our fractional, generally 13 to 18%, 15 odd percent. So I'll give you some real examples. And the real examples I'll give more in fractional, because those are live assets that we've already acquired. So a couple of examples. One asset we entered, we already sold, we got a 17.5% IRR for our investors in fractional, where generally you get 13, 15. So 17 was a higher end. We got it. Other is, there's an asset in Akruti Center Point. ICICI Bank is a tenant. We acquired it at 11,661 rupees per square feet. Last year, in that building, there was a transaction at 15,500 rupees per square feet. So we've not sold that asset yet, but mark to market, if you look at current value, investors are already significantly in the money.
True.
In fact, I can confidently say that each and every asset that we have in our portfolio today is significantly in the money. So as of today, all our assets are performing very, very well.
And goes back to the kind of patience you show for those assets. That's why it's a long-term vision. I get it. So your platform is venturing into GIFT City, and now GIFT City is quite in talks, because now the recent announcement by the finance minister, and there have been few announcements by SEBI also when it comes to foreign trade. I want to know, when you're venturing into the GIFT City with Global Investor Feeder Trust, how will this initiative cater to foreign investors, and what advantage does it bring to hBits?
So the way it works is, there's our AIF. Our AIF is investing in multiple properties. We have Indian investors coming here, and then you have our GIFT fund over here that will invest in the AIF. And in the GIFT fund, you'll have foreign investors coming into the GIFT fund. So the GIFT fund is effectively a pass-through. It basically allows foreign investors to invest in our AIF in a tax-efficient way. So ultimately, investment is the same. It's a structure to enable foreign investors to come into India. And reason we're doing it is quite simple. It's because there's a lot of foreign investor interest in Indian commercial real estate. So I think we are not the only ones. There are a lot of funds that are setting up in GIFT City. See, earlier it used to be Singapore or Mauritius. Mauritius, from my understanding, is not as attractive from a taxation perspective anymore. And Singapore, while attractive from a taxation perspective, is an expensive place to set up a fund. So I think Government of India has done a phenomenal job by creating something like GIFT City. And we hope to have many investors that come in through that fund, which is why our CFO, Samir, he's based between Singapore and Mumbai and has an amazing global network, is already in talks with a lot of global investors.
So overall, what's your take when it comes to GIFT City? Because GIFT City has been there for long. Now it's getting more proactive when it comes to even residential, buildings coming in. Commercial was there for a long time. So what is your overall take on GIFT City?
I think it's like I said, a phenomenal thing. Obviously, like any new initiative, has teething challenges and learnings. But what I'd like to say about that is that, and in fact, we've seen this across the board in various departments of the government, is that they've been very receptive, that anytime there's feedback, they'll incorporate it, and they're working a lot with the industry right now. I met someone at a conference who was part of the who was kind of a part of the government who took the initiative to introduce us to someone in GIFT, since we wanted to set up over there. So they're being very proactive about these kind of things and listening to feedback and incorporating them and getting those suggestions.
So coming back to AIF, and I'm quite curious to know. See, you mentioned, and it is clearly stated in SEBI that the minimized entry is 1 crore, right? So already we are seeing influx of AIF companies coming in, not just on resi front, but also in the commercial front, especially when it comes to Gift City. They all are looking into it because of the tax, being free or evasion. Tax can be evaded for the foreign investors. I want to understand how or what USP would you form to stand apart or stand against or stand differently from the existing AIF companies?
So in terms of resi versus us, completely different products.
Of course, yeah.
So, in terms of commercial,
yeah.
As per my knowledge, there are 2 or 3 other funds who are, there's one other fund that's doing only warehousing. There are 2 other funds that are doing commercial but only pre-leased assets.
Yeah.
So we are in that space, and we've done our research. We're the only fund that is doing commercial under construction, with a blend of under construction and pre-lease. So that's our niche.
So you're saying you don't have competitors in that?
Our competition, obviously, our competitors. Our competitors are all the other investment options.
True.
But in this space, we are the only player as of today. And
that will give you a good upper hand, I think.
Correct. Yeah.
With the new of players coming in.
Yes, and that's why I like to say that the reason we're able to do that, and there's a confidence to do that, is because we have that blended experience in real estate development, as well as in investing. True. That gives us that edge.
So talking about AIF, in Resi, we have seen they also require, SEBI registered trustee and everything. When it comes to commercial space like this, do you guys also have to have a SEBI registered trustee who make sure that, everything is in place and go through the certain...
Absolutely. No, absolutely, we require a trustee. So, in fact, all AIFs do. So we have Catalyst, who we've appointed as our trustee. So kind of they are in charge of the trust, and that's why all the checks and balances are in place for all the investments that are made through the AIF.